Imagine watching an asset lose nearly 50% of its value. From a staggering peak of 120 bars, 67, crashing down, bleeding out, all the way to $64 so panic selling, fear, total capitulation. Most traders looked at silver last week and saw a dying asset. But the professional traders, the institutions, they saw something else. They saw an opportunity of a lifetime hiding in the charts. Ladies and gentlemen, welcome back. Today we are not just talking about the price of silver. We are dissecting a textbook bullish reversal that just happened right before our eyes. Silver has done the impossible. It has reclaimed the 50-day average. It has bounced off a critical channel support, and it is signaling a war against the bears. In this comprehensive breakdown, we are going to analyze the Exagusti chart, bar by bar. We will explain why the reclaim of $78.11 is the most important signal of the month, why the crash to $64 was actually healthy, and exactly where the next battlegrounds are located at $92, $96, and the golden level of $102. If you want to understand how to trade a volatile recovery, this is the only video you need to watch. Let's dive in. Let's start with the headline event, the bullish reversal. You often hear traders talk about trend reversals, but what does actual confirmation look like? According to the data we have, silver confirmed a one-day bullish reversal on Monday. How? By breaking out above Friday's high of $83.78. Now, why does this specific number matter? In technical analysis, breaking a previous day's high is the first sign that buyers have absorbed the selling pressure. But the real magic happened slightly lower on the chart. I want you to look at the level of $78.11. This is the 50-day moving average. The 50-day average is often called the institutional line. It represents the average price over the last 2.5 months of trading. When price is below this line, the asset is in a short-term downtrend. When it reclaims it, momentum shifts. The article confirms that concurrent with the daily breakout, this key level at $78.11 was reclaimed. This provides additional evidence for a bullish recovery. But look closely at the price action. The day's low was $78.51. Do you see the significance? The price dipped down, kissed the 50-day average area, found buyers waiting there, and bounced. It successfully tested the 50-day average as support. Last week, this indicator failed. It broke. But today, it held. This rapid recovery of the indicator is what we call bullish behavior. It tells us that the breakdown was likely a bear trap designed to shake out weak hands before the real move up. To understand where we are going, we must respect where we came from. And where we came from was a brutal sell-off. Silver declined by a massive $57.61 from its January peak of $121.67. That is a 47.4% correction. For many retail traders, a 47% drop screams market crash. But for a technical analyst, this drop had a destination. The price stopped falling at exactly $64.06. Why there? Why not $60? Why not $50? Because $64.06 aligned perfectly with the top zone of a rising trend channel. Here's a golden rule of trading. What was once resistance becomes support. This is known as the principle of polarity. The top of that channel used to be a ceiling where sellers were active. Once silver broke out of it and then crashed back down to test it, that ceiling turned into a floor. The bounce off $64.06 confirms that long-term resistance has successfully switched to support. This validates the structural integrity of the long-term bull market, despite the short-term crash. However, we must be cautious. The analysts note that while this behavior is bullish, it requires additional confirmation that Friday's low will hold as a higher swing low. We are not out of the woods yet, but the floor has been set. Now that we have established a floor at $64 and a baseline at $78, we need to look up. A recovery is never a straight line. It is a zigzag battle between bulls and bears. The article identifies a critical bearish corrective structure. There's a lower swing low sitting at $92.20. This is our first major obstacle. Why is $92.20 dangerous? Because traders who bought at the top and got trapped will be looking to sell as soon as the price gets back to break even or close to it. This creates natural selling pressure. But right next to it, at $93.15, sits the 20-day moving average. The 20-day MA is a faster moving indicator. It broke during the retracement. Now, price is pulling back up to test it. If the price hits $93.15, it will be the second time it tests this line as resistance. Traders, this is your zone of volatility. Between $92.20 and $93.15, expect turbulence. The bears will try to defend this zone to keep the trend down. The bulls need to smash through this to confirm that the correction is truly over. Let's assume the bulls win. Let's assume we clear the $93 resistance. Where's the target? This is where we use the Fibonacci retracement tool, the universal language of markets. If we measure the fall from the peak, we can project the recovery targets. The 50% retracement, 96.49. The halfway point of the crash is 96.49s. In Dow theory, a correction often retraces 50% of the primary move before deciding the next direction. This is a psychological taking profit level. The golden ratio, 61.8%, 102.44. Higher up, we have the most famous number in trading, the 61.8% Fibonacci level located at 102.44. If silver can reclaim $102, statistically, the probability of retesting the all-time highs increases dramatically. But getting there requires sustained buying volume. We have mapped out the levels. But we must discuss the reality of this trade. The article warns us volatility is likely as support gets retested. Given the conviction of sellers during that 47% decline, they won't give up easily. A retest of the support near last week's low, around the $64-70 region, would not be a surprise. This is what we call a consolidation phase. After a sharp fall, markets rarely V-shape recover instantly. They chop, they grind, they test your patience. If you are trading this, your risk management must be impeccable. The bullish confirmation. A daily close above the 50-day average, $78.11. The invalidity point. If price breaks below 64.06, the bullish thesis is dead. The strategy. Watch for reactions at the resistance zones. Do not FOMO, fear of missing out. Buy at resistance. Wait for the breakout and retest. So, here's the verdict on silver, Exagios D. We have witnessed a significant technical event. The reclamation of the 50-day average at $78.11 and the defense of the channel support at 64.06 suggests the bleeding has stopped. The buyers are back in charge. However, the road to $100 and beyond is paved with resistance at $92, $93, and $96. The smart money is watching the close. Can we stay above $78? Can we break $83.78 with volume? If the answer is yes, then the recovery is real. Keep your charts clean, watch your leverage, and remember, in a market this volatile, patience isn't just a virtue, it's a survival skill. If you found value in this deep dive analysis, make sure to subscribe and hit that notification bell. We don't just tell you the price, we teach you the market. For more on how to trade gold and silver, check out our educational area linked in the description below. Until next time, trade safe.